Greetings, it's Charles Thomas from Intrepid Eagle Finance. I'm here today to talk about what happened in the market and the economy during the third quarter. I always like to talk about a little bit of good and a little bit of not so good, and be careful to not get overly exuberant on the positive side of news while not dwelling too much on the not so good. Starting with the positive, though, we saw the specter of another government shutdown toward the end of September. We didn't expect a big impact in the market, but nonetheless, the shutdown and the impact didn't happen. There was a compromise reached. We'll talk more about that in a few minutes. When we look out at the bond market, another name for bonds is fixed income instruments. And because they have that income component to them, well, that income is the best it has been in years. We'll also talk more about that. The labor market, although it's not perfect, continues to be strong, historically speaking. When you look out on the less positive side, for a while, a lot of people thought the Federal Reserve would only raise interest a little bit and we would be past that at this point. Well, that is not proven to be the case at all. Rates have all the appearances that they're going to be higher for longer, and that's going to contribute to higher intermediate and long-term yields. More to come on that. When we look out at the biggest U.S. stocks, those have been very positive, but what we're seeing is that's driven by a small minority of companies. We'll talk more about that. And then lastly, the U.S. dollar is very strong, but that has negatively impacted some other things that we'll talk about that for international companies. But first, more on the government shutdown. So to give you a little bit of context around this, Congress came to a compromise at the end of September to avoid a shutdown. And that was a temporary compromise because what it did is it continued to fund the government, but only through November 17th of this year. Now, the question I get a lot is, should I be concerned as an investor about how this is going to affect things? And my short answer is no, you shouldn't if history is any indication. If we look back over the last couple of decades, there's been 21 different government shutdowns since 1976, believe it or not. And if we go break those out for what the financial markets did during that time, it's very mixed. We break it out. We saw the S&P 500 go up 11 of those different shutdowns during the shutdown. 9 of the times we saw the market go down during the shutdown. And there was one shutdown that was so short that happened overnight while the markets are closed. So we didn't get to see either way. So if history is any indication on that, the market doesn't feel any particular way about a government shutdown. Could it be different in the future? Sure, it absolutely could. But there's definitely not a definitive one way or another about how these things go. Speaking of the government, we can talk about the Federal Reserve. That continues to be a big piece of news. We talk about the Fed's pace, pause, and pivot is what I like to call the 3 Ps. And the pace of increases has started to slow some. The last few increases, instead of being 0.5% at a time, the Federal Reserve decided to do 1/4 point at a time. But there's also this big lag that we see when they make changes. When they make a change during a particular month, we don't know what the actual impact of that is for at least a while after that. So we'll see what that is. Eventually, the Federal Reserve is going to get to a point where they pause on their rate increases. We don't know when that's going to be. I think you can decide for yourself whether they know. Eventually, we'll get to a pivot, and that'll be when interest rates come back down. Again, anybody's guess on what that is for the Federal Reserve. And then the Federal Reserves themselves is not completely sure about when that's going to be. And let me explain what that looks like. Now, the Federal Reserve, it gets spoken of as this singular entity. And that's not exactly right. The Fed is actually made up of different members. And when they went out and asked the different members of the Federal Reserve, what do you think interest rates are going to be in December of 2024? Well, they got a lot of different answers. There were a lot of them that said, we think it'll be between 4.25% and 4.5%. You had one member of the Fed thought, oh, it's going to be 6%. It's just all over the map, as you can see on that column around December 24 there. The other takeaway is this from this survey is this nice little green line, this nice little stair step from December of 23 through December of 24. It's an implied step down, and it's kind of a mirror image of what we saw start in December of 22. Now, that's what comes from the Federal Reserve survey. But if we go look at what's happened in the past, doesn't look anything like that. Up like an escalator, down like an elevator. So what does that mean? This is what increases and decreases from the Federal Reserve have looked like over the past couple of decades. And what we see, they are very quick to drop rates, but very slow when the rates start to climb back up. Now, why would that be? Well, when rates are lowered, it's often in response to something that is going on, some big event. If you go look at the dates around some of the drops, you could probably figure out what's going on around those times. So 2020, 07, 08, early 2000s, the tech crash. The Federal Reserve at those times, they're responding very quickly and decisively to particular events, trying to lower rates. When they're going the other direction, when they're raising rates, they're being much more measured and slow about that, how that goes. So up like an escalator, down like an elevator is what has been the case the last couple decades. We'll have to see, time will tell about what happens this time around. Looking toward individual parts of the markets, let's talk about bonds first. When you own a bond, when you own fixed income investments, you expect to be compensated based on how long your money is invested for. So if you're going to have a longer term bond, you expect to be paid more for that than a shorter term bond. We call that difference, it's called a term premium. So as we saw, the short term yields have risen and got an even greater increase across the quarter. For the intermediate and long-term parts of the yield, it's been influenced by a number of factors. As prices are become more inverted to yields, most of the bond indexes have gone down for the quarter. When we look out longer term at year to date in the last 12 months, more positive from that standpoint. Now, I want to hold in on a couple of individual pieces of that. One of the big measures that you might hear in the news sometimes is around the 10-year Treasury Bond. And it affects us in more ways than you might think. You might own part of that as an investor, but it's also something a lot of people look at as a barometer for things like investor confidence and the economy as a whole. It's also important for other things like how rates on mortgages are set and other types of debt that you buy as a consumer. Makes a difference from that. The rates on that have continued to climb. We're just now getting to a point where we haven't been in about 15 years as far as the rates on 10-year treasuries go. When we look at what we call the treasury curve, the difference in between the short-term, intermediate, and long-term bonds, this has been what we call inverted for a while. The difference in between what you're paid for long-term versus short-term, but it's less inverted now than it was. And that's a good thing because we want that to get back to a healthier place and more akin to what we know longer term. Moving away from bonds over to stocks in the United States, we saw those down for the previous quarter. But when we look at longer term, we look at the year to date and the last 12 months, still very positive from those measures. In particular, I'll mention what we call the large cap growth stocks. They've done very well for the quarter in the last 12 months, with being year to date being up 25%. But there's this odd thing happening with that. As much as that is up, it's due to just a few different companies. And here's what I mean by that. This chart takes the 7 best performing companies out of the S&P 500, and it breaks down the seven best and the other 493. And it's incredibly stark difference that we've seen over the course of this year. A lot of that return that has been so good is very concentrated toward the top. It's just those 7 companies making up an outsized portion of that return, and the other 493 are essentially flat for the year. It's a very stark contrast. If we had our choice, we would prefer for that to be more even and see those gains more equally shared among more companies, but it's something to watch. We'll keep an eye on that. Now, those are the biggest companies when we talk about the S&P 500. I want to talk about the smallest now. And this is a different measure that you may have seen before. It's called the Russell 2000. So it's 2,000 small companies. And there's this odd thing that I want to point out when we look at these. With the Russell 2000 to be on that list that they make of those companies, the criteria is different for any list of that, what we call a stock index. For this one, though, to be on that list, you don't have to turn a profit. So this is companies that make up that index, that measure, that don't turn a profit, are not profitable. It's about 45% right now. When we think about just common sense economically, over a long period of time, for a company to be around and continue to be an ongoing concern, you got to turn a profit. It just makes sense. Also makes sense that if you're going to continue to perform well from a stock standpoint, we want to have companies that are profitable. That's why one of the things we look at, and we're including different investments, is profitability. That's not the only thing, but that's a piece of it, because we want those to continue to be around for the long term. That's a piece of that. So something to keep in mind. When we look outside of the US, some similar themes to what we see in our country. Down for the quarter, but up year to date and the last 12 months, but less so. And there's a reason why that is. It has to do with the US dollar. The US dollar is a double-edged sword. When we look at this chart here, the US dollar right now is very strong compared to where it's been the last 10 years. And that's compared to other currencies in the world. So this compares to about 16 other countries, how we're doing against their currencies. So think about China's currency, think about South Africa, the Mexican peso, all these different ones. Compared to those, US dollar is very strong. And that's great for us as consumers when we want to buy goods from overseas. It means our dollars go further and have more purchasing power. That's very good for us. But from our standpoint as investors, that difference in that currency, that strength of the US dollar, it hurts us there. It means when we own investments that are outside of this country, that are based in other countries, that currency conversion, when it comes back home, that hurts us. It also hurts US-based companies that are doing business overseas. It means when they bring those profits back home, they get hurt in that conversion as well. So double-edged sword. Now, I picked on the US because we're very concentrated with just a few companies doing well. I wanted to look at it through the lens of comparing us to other places as well. If you look in the middle, the stock 600, that's mostly Europe. They're much more evenly distributed with the gains they've had. We look at Japan over here on the right, similar story, also more evenly distributed. Let's spend a minute talking about China. One of the questions I get a lot is about China, because China is in the news just all the time. And just to frame where China sits for its place economically in the world, China constitutes about 1/3 of what we call emerging market stocks, those rising economies in the world. So if you were going to make the decision, say, hey, for whatever reason, I want to exclude China and not invest in anything related to China, well, you're taking out a large portion of what is out there. And by definition, that means you're investing more in other places. So investing more in Brazil and other places like that. That's what happens. That's why we don't necessarily advocate for carving things out and trying to do that, because it's very difficult to do that effectively. The other thing I'll point out is, although China gets all the news, when we look at the next 4 biggest emerging market economies behind them, so think about India, Taiwan, Korea, and Brazil, they've actually done better than China over the last 12 months when it comes to the performance of their economies. So just because they don't get the news doesn't mean they're not getting the good results. And so a couple of things I will mention just as we near the close here is enduring principles I like to remind folks of. Financial planning is a process. It's not an endpoint. We want to continue to concentrate on long-term goals and objectives. We want to focus on reaching goals, not beating benchmarks. We want to maintain a disciplined approach in good and bad markets. We want to invest broadly and globally. Asset allocation is key. We want to reduce investment and tax costs wherever possible and rebalance as necessary. And the final thing I'll share with you, just a reminder about why diversification, that principle from Ecclesiastes that we get, is so important. This chart that looks like the periodic table is a representation of different types of investments and what they do in any individual year. And as you'll see, every color is distributed across here. There's very little rhyme or reason to it. This is why we advocate for investing in many different things, because we never want you to be invested solely in something that's going to be at the bottom of this list. We want to be equally distributed, and we believe that's the best way to accomplish what your family is seeking with investments to serve your goals. And so that brings us to the end there. Well, thank you for joining me, and hope you have a blessed day. Thanks so much.